At the open of currency markets on the 2nd of July, 1997, the Bank of Thailand was holding its last line of defense. It had spent $33 billion in foreign exchange reserves over the preceding months, trying to maintain the baht at 25 to the US dollar, a peg that had been in place for over a decade, the foundation on which Thailand's extraordinary growth had been built. The reserves were exhausted. There was nothing left to sell. That morning, the Thai government announced a managed float of the baht. By the end of the day, the currency had plunged 15 to 20%. Within 6 months, it would reach 56 baht to the dollar, a collapse of more than 50% from its pegged rate. What happened next was not predicted by the International Monetary Fund, not anticipated by the governments of the region, and not remotely understood by most of the global investors who had poured capital into Southeast Asia throughout the 1990s. A currency crisis in one mid-sized emerging economy cascaded in less than 12 months into the deepest financial collapse Asia had experienced since the Second World War, sweeping away decades of economic development, toppling governments, and costing tens of millions of ordinary people their jobs, their savings, and in some cases their lives. The question of who caused it, currency traders, governments, the IMF, or the structural vulnerabilities of the Asian model itself, was argued at the time and has been argued ever since. The full answer, too, requires examining all of them. To understand why 1997 happened, you have to understand what the decade before it had built and what it had concealed. Between 1985 and 1996, Thailand's economy grew at an average rate of over 9% per year. Indonesia, Malaysia, South Korea, and the Philippines recorded similarly extraordinary rates, sustained over a decade or more. This was the period that economists described as the Asian economic miracle, a phase of export-led growth, high savings rates, and disciplined fiscal management that had lifted hundreds of millions out of poverty and produced a new industrial middle class across the region. But the miracle had a structural dependency. The high growth rates attracted enormous quantities of foreign capital. Between 1994 and 1996, net private capital inflows to the 5 most affected countries, Thailand, Indonesia, Malaysia, South Korea, and the Philippines, surged from $40.5 billion to $93 billion. Much of this money was not long-term foreign direct investment. It was short-term lending, overnight deposits, revolving credit lines, and portfolio flows that could be withdrawn in hours. This capital had entered on one critical assumption, that the exchange rate was stable. Almost every affected country pegged its currency directly or indirectly to the US dollar. This peg was not merely a monetary policy choice. It was the signal that attracted the money. A Thai corporation could borrow in dollars at low American interest rates, convert to baht, and invest locally at higher domestic returns, a profitable carry trade as long as the exchange rate held. The hidden vulnerability was that the corporate and banking sectors of these economies had accumulated vast quantities of unhedged dollar-denominated debt. If the exchange rate moved, their liabilities would grow in local currency terms without any corresponding growth in their local currency revenues. The peg was not just a policy, it was the load-bearing wall of the entire financial architecture. When it broke, everything built on top of it fell with it. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world. The crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us, and we want to hear from you. Did you live through one of these turning points? The 2008 collapse, the 70s oil shock, the end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. The dollar peg had been the engine of the Asian miracle. By the mid-1990s, it had become its most dangerous liability. The peg worked as long as two conditions held simultaneously. U.S. interest rates remained low enough to make the carry trade profitable, and the Asian economies remained competitive enough to generate the export revenues to service their dollar debts. Both conditions began to deteriorate in the early 1990s. The Plaza Accord of 1985 had intentionally weakened the dollar to reduce America's trade deficit. Asian currencies pegged to the dollar had weakened with it, making their exports extremely competitive in global markets. But by 1995, the dollar began to strengthen again, and the pegged Asian currencies strengthened with it. Thai exports grew by only 1.9% in 1996, compared to 24.8% the previous year, the sharpest deterioration in Thai export performance since the country had adopted its export-led growth strategy. Current account deficits widened across the region. The trade position that had justified the inflow of foreign capital was visibly deteriorating. The second problem was the lending environment that the peg had encouraged. Because the exchange rate appeared stable, Thai and Indonesian banks and corporations had borrowed in dollars without hedging their currency exposure. Thailand's international debt had reached $109 billion by the end of 1997. The country was running a current account deficit of roughly 8% of GDP. Every dollar that the Bank of Thailand spent defending the peg was a dollar that would not be there when the defense finally failed. The region had walked into a classic currency trap. The very stability the peg appeared to provide had encouraged excessive risk-taking. The excessive risk-taking meant the peg could not be maintained, and the inability to maintain the peg, when it was finally exposed, produced a crisis far worse than a gradual adjustment would have done. George Soros was the most famous name attached to the Asian crisis. He was not the only currency trader who moved against the baht, but he was the most visible and the most consequential to the political argument about who bore responsibility for what followed. Soros's quantum fund had established short positions in the Thai baht and Malaysian ringgit early in 1997, entering into contracts to sell currencies they did not yet hold at prices they believed would be unattainable when the contracts fell due. In his own account, Soros said the trouble could be seen 6 to 9 months before it materialized. Thailand's trade account was deteriorating sharply. The capital flows required to sustain the peg were expanding faster than the economy could generate them. He anticipated a devaluation. His fund positioned for it. Soros was not alone. Multiple hedge funds, international banks, and regional investors had reached the same conclusion about the Thai baht and other pegged Asian currencies by mid-1997. The speculative attacks that the Bank of Thailand fought off in May 1997 represented the coordinated weight of a market that had collectively concluded the peg was unsustainable. The more contested question is whether those speculative positions caused the crisis or whether they accelerated a collapse that was structurally inevitable. Soros himself, in a 1999 interview, stated clearly, "I don't think it was so much the speculators attacking the Thai currency at the outset. There were a large number of private loans to Thai borrowers in foreign currencies. When the peg broke, those borrowers needed to cover their positions. The crisis was driven as much by Thai debtors rushing to buy dollars as by foreign speculators selling baht." This is the distinction that the political argument around Soros often obscured. Markets that are structurally overvalued will be attacked. The question is not whether the attack is justified, but whether the underlying vulnerability that makes it possible is the fault of those who identify it. Whether you view Soros as a force for market discipline or as a speculator profiting from the destruction of development, the evidence on the underlying vulnerability is unambiguous. Thailand's economy had structural problems that its government had delayed addressing for years. The attack on the baht did not create those problems. It exposed them. The contagion moved faster than any institution was prepared for. The Philippines floated the peso on the 12th of July. Malaysia abandoned its exchange rate peg on the 14th. Indonesia floated the rupiah on the 14th of August. South Korea held out longer. Its won appeared more stable, its economy more diversified. its financial system more sophisticated. But by October, the won was under severe pressure. By late December, it had fallen 55% to its lowest level in history. By January 1998, the scale of the currency collapses was staggering. The Thai baht had lost 56% of its value against the dollar, the Malaysian ringgit, 46%, the Philippine peso, 41%, the Indonesian rupiah, 81%. Entire national economies had lost half or more of their purchasing power in less than 6 months. The mechanism of contagion was partly rational and partly panic. The rational element was that investors who reassessed Thailand's structural vulnerabilities immediately looked at other economies with similar characteristics: dollar-pegged currencies, large current account deficits, unhedged corporate. The International Monetary Fund's response to the Asian crisis became as contested as the crisis itself. At the combined annual meetings of the IMF and World Bank in Hong Kong in September 1997, the central argument erupted publicly. Malaysian Prime Minister Mahathir Mohamad, whose country was rapidly losing control of its ringgit, stood before the assembly and accused currency speculators, George Soros by name, of deliberately destroying Southeast Asian economies for profit. Soros, present at the same meetings, responded by calling Mahathir a menace to his country. The exchange between a hedge fund manager and a head of government at the world's most important financial gathering was without precedent. The IMF offered its standard medicine to the affected countries. In exchange for emergency lending, Thailand, Indonesia, and South Korea accepted packages of structural adjustment, austerity, interest rate increases, the closure of insolvent financial institutions, and corporate restructuring. The conditions were intended to restore confidence, stabilize currencies, and establish the fiscal discipline that would reassure international investors. Critics argued that the IMF's prescription made the crisis worse. Raising interest rates in the middle of a recession deepened the contraction. Closing financial institutions triggered further panic. Imposing austerity reduced the purchasing power of populations already impoverished by currency collapse. The debate over whether the IMF's interventions helped or harmed the affected populations remains active among economists today. Mahathir made a different choice. In September 1998, Malaysia imposed capital controls, fixing the ringgit at 3.8 to the dollar and preventing foreign investors from removing money from the country for at least a year. Western economists almost universally condemned the move. The IMF disapproved. The conventional wisdom was that capital controls would destroy investor confidence permanently and isolate Malaysia from international financial markets. The conventional wisdom was wrong. Within 2 years, Malaysia had recovered more rapidly than Thailand or Indonesia. The ringgit peg stabilized the economy. Capital controls bought the government time to restructure without submitting to IMF conditionality. Mahathir, who had accused Soros of causing the crisis, an accusation he would retract in 2006, turned out to have found one of the more effective responses to it. The 1997 Asian financial crisis was not caused by one person, one institution, or one decision. It was the product of a decade of structural vulnerability, a liberalized capital account that made rapid reversal possible, currency pegs that created false stability, governments that delayed necessary adjustments, and yes, currency traders who identified the instability and profited from it. The economies that suffered most severely were among the most remarkable development stories in human history. Between 1960 and 1997, hundreds of millions of people across Southeast and East Asia had moved out of poverty, achieved literacy, built industrial economies, and entered a consumer middle class. The 1997 crisis reversed years of those gains in months. From 1996 to 1997, nominal GDP per capita dropped by 43.2% in Indonesia, 21.2% in Thailand, 19% in Malaysia, 18.5% in South Korea, and 12.5% in the Philippines. These were not market adjustments. These were depressions. The crisis produced 3 lasting consequences. First, every affected country in Asia dramatically increased its foreign exchange reserves after 1997, insurance against future speculative attacks. Today, Asia collectively holds the world's largest reserve balances, partly because of what happened in 1997. Second, the crisis produced a permanent skepticism about the IMF's one-size-fits-all approach to financial crisis management. Mahathir's capital controls worked better than the conventional prescription. Joseph Stiglitz, the Nobel laureate economist who was chief economist at the World Bank during the crisis, argued publicly that the IMF's conditions had made the situation worse. Third, and most consequently, the crisis accelerated financial integration between Asian economies themselves, including the beginnings of the Chiang Mai Initiative, a network of currency swap arrangements between Asian central banks designed to provide the liquidity backstop that the region had lacked in 1997. The currency traders who positioned against the baht identified a real structural problem. The governments that maintained unsustainable pegs compounded it. The IMF prescribed medicine that often worsened the patient's condition, and the millions of ordinary people who had no seat at any of those tables paid the price for all of it. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.